Bear markets are no fun for long-term crypto investors, and the wild gyrations of the market make buy and hold an exceedingly tough proposition when the world is falling apart, since by definition as a hodler, you are supposed to hold the bag on the way down too. I am dedicating this video to those non-traders in my audience, to those long-term investors who painstakingly accumulated their beloved crypto stacks and refuse to be shaken out of the market no matter what. To you, I have to say this. Hodling does not mean that you have to stick your head in the sand and close your eyes on risk management altogether. What if there was a way to cut a good portion of your risk without frantically trading in and out or deconstructing that portfolio that took ages to build up? And what if it only took you one single trade and zero guesswork to make it happen? Interested? I'll see you on the other side. Aside from outrightly selling your positions and sitting on your hands as you watch the market burn, properly hedging a cryptocurrency portfolio is easier said than done, and that's mainly for three reasons. First, even if you agree to destroy your portfolio and liquidate your holdings, selling is not always a given, since many cryptocurrencies can be bonded to a staking protocol for collecting interest in return for securing the blockchain. That short-term vesting mechanism will typically prevent you from pulling your holdings before the end of an unbonding period that can last anywhere from 7 to 28 days in most cases. Second, being able to put your hands on an over-the-counter hedging derivative that is not grossly overpriced is akin to finding a needle in a haystack. And third, this fairly new asset class lacks an extensive price history to help solidify any mathematical modeling and ensure that you are applying the right amount of hedging. So what remains? Well, for as much as we can blame the introduction of Bitcoin futures and then Bitcoin futures ETFs for perfectly timing the top of both previous bull cycles, these new instruments have introduced with them equity options and a more transparent way to price and trade crypto derivatives, and with them, a less suboptimal medium of hedging your portfolio. Before anything else, we have to recognize that these ETFs are futures-based and not physical-based. What it means is that they themselves are second-degree derivatives of the real Bitcoin. And there are tons of problems that arise from that alone, all of which affect the way these ETFs are pegged to the actual price of Bitcoin, be it because of the contango or backwardation of the futures market, the rollover cost involved in tracking the consecutive futures contracts, the discrepancies between their net asset value and their actual underlying holdings, etc., etc. In other words, these ETFs are not a panacea, far from it. But still, there's enough juice here to extract a decent synthetic hedge with a little effort, since, as I said, these ETFs have this advantage to be optionable with listed options, as opposed to their opaque over-the-counter cousins. This video is not about derivatives, so I will skip the general math that underpins options pricing. For the purpose of today's demonstration though, I still want you to keep in mind a few key concepts. You need to know that options are literally insurance products, each bearing a maturity deadline and an activation hurdle called a strike. The strike is expressed in terms of a price beyond which that insurance policy will have value at maturity and will make the option worth exercising in order to indemnify its subscriber. Options can be both bought and sold, implying that you can either set yourself as the subscriber of the insurance policy or the insurer itself. In today's case, we will position ourselves as buyers of put options, where puts are the right to sell the underlying asset at a given price. So for example, let's assume a put option with a strike of $30,000. If Bitcoin were to drop below $30,000 before or at the option's maturity, as put buyers, we would exercise our put option and have the counterparty buy our Bitcoin at $30,000 no matter what, thereby forcing them to compensate us for any loss incurred below $30,000. As you can see, this is the very definition of an insurance. Fairly simple concept here. Options are priced according to a set of parameters that express the assumptions made by the market as far as the likelihood and the scope of the price deviation anticipated in the insured asset until that maturity date. In general, the higher the volatility of the underlying asset, the longer the maturity, and the closer the strike, the more expensive the option, and vice versa. Now, if the pricing of listed options on Bitcoin ETFs is indeed transparent, knowing how many option contracts we need to trade is not as straightforward as doing a mere cross calculation. And that's because being a derivative of a derivative of a derivative, these options are 3 steps removed from the actual Bitcoin and an additional step away from your portfolio. So sizing our hedging trade requires a few extra adjustments. This is where this course comes in the picture. Now in the following step-by-step demonstration, you simply need to keep in mind that hedging with derivatives is not an exact science, but this 5-step process remains well defined as follows. Step 1. Since we are eventually going to trade Bitcoin-related options and our portfolio likely does not uniquely consist of Bitcoin, we need to quantify the relative behavior of our portfolio as a whole versus Bitcoin. There is no need to do a correlation test here since all cryptos are significantly correlated with Bitcoin itself. What we want to gauge instead is by how much our portfolio is under or overshooting Bitcoin's volatility, or in other words, by how much we can expect our portfolio to move in relation to Bitcoin's movements. Because obviously, the more it moves, the greater the hedging power we're going to need. To that effect, we will first want to download the time series describing the historical daily closing prices of those cryptocurrencies that our portfolio is comprised of. You can readily do so for free and without even logging in, straight from Yahoo Finance, with history stretching as far back as September 2014 from what I could check. Not the most accurate, highest quality data out there for sure, but that will do the job just fine in most cases. To illustrate this step, we'll consider a simplified portfolio with allocations in 5 cryptocurrencies as follows: 25% in Bitcoin, 25% in Ethereum, 20% in Monero, 20% in Cardano, and 10% in Dogecoin. Total 100%. Once the price data has been downloaded, we calculate the percentage daily price change for each coin. Then we consolidate these into a single column, weighted by their respective allocation, to obtain the daily percentage change of our portfolio. Once done, we calculate the relative volatility of our portfolio versus Bitcoin, which is achieved in Excel using the ratio of the covariance of both our portfolios and Bitcoin's daily returns divided by the variance of Bitcoin's daily returns. That is your run-of-the-mill so-called beta. Now, if you stop here, you will feel like you accomplished something because that is what all books of financial theory will tell you to do. Except that a standard beta is a very poor way to quantify real-world relative volatility. If you do not believe me, then proceed with this exercise by calculating the beta of a portfolio made of 50% Bitcoin and 50% in Dogecoin. Then go ahead and compare Bitcoin with the actual behavior of your portfolio. That alone should settle the debate. Once again, I am urging you to think outside the box by applying some common sense to what is written in mainstream financial literature. You should take nothing as gospel and push yourself to think things through before you use these agreed upon concepts. Remember, we're not trying to get a 4.0 on a stupid midterm exam here. We want to achieve something financially, namely actually hedging our portfolio in the real world, and that requires a reality check. So instead, we'll modify our beta by calculating it as the straight ratio between the standard deviation of our portfolio's daily returns over that of Bitcoin's. In the case of this example, it raises our standard beta from an unrealistic 0.984 to a more true-to-life adjusted beta of 1.174, and that is the value that we will be using going forward. Step 2. We have to remember that we will not be trading options on BTC, but rather on a proxy to Bitcoin futures, which is our ETF. So we need to perform a similar calculation in order to find the ETF's adjusted beta. We repeat the same process here, except that this time we only need to download one time series compiling the daily prices of BITO, which is ProShares ETF's version. Now, if you wish to pick Valkyrie's version instead with the BTF ticker, have at it. Both ETFs are so similar in pricing outcome that it will barely change the result of this exercise. Unsurprisingly, our adjusted beta is not equal to 1 because, being pegged to the futures market, these ETFs are an imperfect proxy to Bitcoin. Our adjusted beta comes up to 1.024 as of making this video. Step 3. We need to pick a maturity for our hedge. Just like determining your own risk aversion and expressing it in terms of maximum drawdown, unless you have a tangible reason to prefer a given maturity over another one, for most people, picking your hedge's term will be more dependent upon personal preference than anything else. As in, for example, you would want to hedge your portfolio until the end of the year for tax reasons, or until you have to make a big purchase at a certain date using your crypto as a funding source, etc. With that said, you can still make your decision based on more objective criteria, even though most of the time they will remain based on the limited insight that historical statistics can provide. For example, this is what we attempted to do by trying to pinpoint a bottom and a term in this video, where I reviewed the expected outcome of the 2022 Bitcoin death cross, which turned out to hold for about 4 months and then crumbled for a lack of statistical history. So for the purpose of this course though, we will arbitrarily consider a 1-year maturity to avoid overcomplicating the demonstration. Step 4. Once our maturity has been chosen, we need to pick a strike, meaning a Bitcoin price level below which we wish to be insured against further decline. Yet again, unless you really need to be hedged at a particular level for personal reasons, there is a way to refine your target and make that choice more relevant from a quantitative standpoint. In that case, we need to remember the following. Exercising an insurance is supposed to be a last resort tool used to shore us up against an extremely adverse financial outcome, not against Mr. Market's everyday little hiccups. In other words, we need to discriminate between average and extreme risk. Typically, we would not want to hedge ourselves against average risk, meaning every dip that Bitcoin is going through. To use an analogy, If you were to insure your car tires, you would not want to buy an insurance to cover yourself from recurringly scratching your tire wall against the curb every time you park. Doing so would be prohibitively expensive. Instead, you would only want to buy insurance against an all-out puncture that would require you to change the whole tire. With our Bitcoin hedging, the thought process is the same. We want to quantify and distinguish average versus extreme risk, and only target for insurance that range which qualifies as extreme. To achieve that, we will recognize that without the intention or the capacity to use any trading model other than DCA, which is the case for most hodlers, we will not be able to beat the average. So it means that we will draw a line in the sand at the average drawdowns experienced by Bitcoin, which sets it at about the minus 48.48% mark historically. As of mid-2022, it implies that we would only be looking at BITO strikes in the closest equivalent neighborhood of $35,527 for the price of Bitcoin, using a Bitcoin peak value reference of $68,958. In BITO terms, using our adjusted BITO to BTC beta from a BITO peak value of $44.29, that would translate into a strike for BITO of about $22.3, which we will round up to $23. Step 5. We need to size that trade. In our example, we will assume that we want to hedge 100% of our portfolio below the hurdle that we just defined. Let's assume here that on November 24, 2021 at the close, we decided to hedge a $500,000 portfolio for about 1 year until the listed December 16, 2022 maturity. It is important to note here that on November 24, 2021, Bitcoin had already dropped by minus 17.1% from its all-time highs. So by factoring in the portfolio to Bitcoin adjusted beta that we measured earlier to be 1.174, it implies that our initial portfolio value of $500,000 on November 24, 2021 was likely already down by minus 20.07% from its maximum value reached at the tip of the market. Said differently, it conversely implies that the maximum portfolio value was 25.11% higher than the initial portfolio value, and that its maximum value was $625,545. This reference value is the anchor that we will be using to calibrate our position sizing. Using it and the fact that we set our strike at the equivalent of Bitcoin's average historical drawdown of minus 48.48%, our adjusted portfolio to Bitcoin beta allows us to reasonably expect that our portfolio value will have dropped by minus 56.9% down to $269,620 by the time Bitcoin reaches the strike. So now we have everything we need to both size our trade and project an estimate of its outcome. We have our maturity of 1 year, our strike of $23, and our projected portfolio value of $269,620 at the strike. As you can see, we avoided making the typical mistake of calculating our hedge based on our peak or initial portfolio values, and it would be incorrect indeed. Doing so would mean overpaying for our insurance, since by choosing a lower level for our insurance to kick in, we implicitly accepted to sacrifice our portfolio down to the strike in order to pay a lower premium. That is why we're only targeting for hedging, not the peak portfolio value, not the initial portfolio value either, but that lower projected equity of $269,620 and nothing anywhere above that. Now with that in mind, it's time to turn to the options market and check our premiums. On December 24, 2021, at the close, the value of our BITO put struck $23 expiring December 16, 2022 was $2.49, back when BITO was trading at $36.69 and the option still had 387 days to go. Hedging $269,620 worth of projected crypto portfolio at the strike would have therefore required to buy $269,620 divided by our strike, $23, divided by our contract size of 100 shares, and multiplied by both our adjusted betas of 1.174 and 1.024. That is 141 contracts. That is also a total cost of $35,109 or 7.02% of the initial portfolio value on November 24th or 13.02% of the projected portfolio value for the privilege of insuring our portfolio against a drawdown that is higher than average. While some might find it expensive, some others will appreciate the peace of mind, and it's anyone's personal risk aversion at this point, and I'll let you be the judge. Regardless, let's simulate the benefit of our put option should Bitcoin drop to 21,000, for example, or by minus 63.26% from November 24, 2021 by the time our option expires. There will also, by the way, be a drop of 69.55% since its peak value. Using the same scaling betas that we used so far, we can expect our portfolio to be down minus 81.62% from its peak to a market value of about $114,955. At this level and at maturity, our ETF would expectedly be worth $12.74, which would make our option be worth $10.26 per contract. At maturity, our insurance payout would therefore be 141 times that $10.26 premium times 100, the contract size, or $144,666. That amount would bring back the value of the portfolio to $259,621, close enough to the projected portfolio value at the strike, which we estimated to be $269,620. So the option did do most of its job to cap our losses at minus 58.50% from the peak, instead of minus 81.62% had we not hedged. Now evidently, this option did not come for free, far from it, and we paid a premium worth 13.02% of our projected portfolio value for the privilege. So our net portfolio value at maturity really is $259,621 minus the $35,109 premium, or about $224,512, thereby materializing a net loss of minus 64.11% from the peak, instead of the headline gross loss of minus 58.50%. Our net percent hedge was therefore 17.51% of our peak portfolio value. As you can see, if the math to hedge a crypto portfolio is not rocket science, there is a clear approach to do it. Even with these steps though, the hedge was not exactly spot on, because it cannot be with proxies. We are working with too many moving parts and approximations here. Also, the Bitcoin ETF options market is very expensive because of the volatility of Bitcoin itself, and it belongs to you to figure out whether it is worth paying a high cost for insuring your portfolio or not. It should be pretty clear by now that Bitcoin options are worth it only if the worst case scenario materializes. Anything milder makes it a very arguable solution. Now obviously, early birds get the worm, and if we overlook the time value of our option, the earlier we hedge before a bear market, the cheaper it is. So being able to time our hedge trade is crucial in this exercise, because that is how we can best minimize our insurance cost. Picking November 24th, 2021 as the start of our hedge trade was not a coincidence. A good indication of when to bail and start looking for countermeasures can be found in this video, where I detail this simple quantitative model to help you do just that. So I guess that will do it for this one. Do not hesitate to comment with questions below in case anything wasn't clear. And remember, it is not because you have a long-term view on your investments that you should remain a sitting duck when the tide turns. Hope is not an investment strategy. Planned risk management is. I'll see you in the next one.